What would your future look like if you didn't have a mortgage balance? Picture being debt-free and living a life of financial freedom. I'm Linda Myrick, and I'd like a few minutes of your time to tell you about a life-changing financial tool. I've been in financial services for 30 years, serving the greater Pacific Northwest. I've helped hundreds of families realize their dream of homeownership by providing mortgage financing for homes. And I love this business because homeownership is the American dream. It creates strong families and communities and gives people a feeling of immense pride. And for me, there's no better feeling than helping people reach their goals.
The all-in-one loan is a financial tool. It combines a checking account with a mortgage. And when you make deposits in the checking account, they sweep over to the mortgage and pay the principal before the interest. The interest is then calculated on that reduced amount. So
let's say you have a $600,000 mortgage and you receive a payroll deposit of $10,000. Well, at the end of the day, that deposit swept over to the mortgage and makes the balance $590. Now you're paying simple interest based on $590 rather than front-loaded interest that's paid on the $600,000. The principal is paid before the interest. Now think about your current mortgage and checking account and how they work today. You receive your paycheck deposit, and the funds sit in the account earning next to nothing until you need the money to pay bills, including your mortgage. Mortgage debt is statistically the largest debt Americans will carry for their entire life, and it's difficult to pay off. It consumes a lot of hard-earned money in the form of interest payments, very similar to credit card debt, but on a much larger scale. Well, nobody wants to overpay for anything, including a mortgage. Now, with a traditional mortgage, the fixed payment doesn't go down when the cost of living goes up.
this is the only loan that benefits the customer rather than the bank.
Now, with this tool, your payment goes down and your balance goes down. It's a win-win. Imagine retiring years earlier because your home's paid off. Or imagine buying a vacation home on the water or in the mountains. How secure would you feel knowing that you could tap into your home's equity without using your savings or 401k to fund an unexpected emergency? You could pay for college for your kids. These are all things that we are helping people achieve. Now, most Americans will earn more money in the next 5 years than they owe on their mortgage. Think about that. Think about what would happen if those earnings were deposited into a checking account that automatically pays down the mortgage balance. It's a first lien home equity loan that's combined with your checking account. The loan's paid faster because your checking deposits are swept nightly to the balance of the mortgage. It's so practical and simple. Now, Einstein said compound interest is the eighth wonder of the world. He who understands it earns it. He who doesn't pays it. This applies to females too, but it sounds like he's talking about the all-in-one loan. Imagine being your own bank and having control over rapidly paying the balance of your mortgage to zero. But what happens when you need to pay bills and living expenses? The checking account is fully functional and includes every feature that today's checking accounts offer. Your money is available 24/7, and when monthly expenses clear the checking account, the funds are taken from the home equity loan, which is the mortgage. What's different is that money is not sitting idle in your checking account earning little to no interest. So the money's housed in the home equity loan, working to keep your mortgage balance lower while saving daily interest expense. So how is the mortgage payment paid? Well, you don't physically make a mortgage payment. Once a month, the interest from each day is calculated, and that amount is deducted from the available balance on the home equity loan. Remember, the interest is lower because it's calculated daily after you make deposits. This is how you can pay off your mortgage very quickly without making any changes to your saving and spending patterns. You can use the all-in-one loan to purchase a residence, a second home, or investment property. And you can also use it to refinance your current mortgage.
We're 15 years in with this traditional mortgage. We're looking for a refi. We realized the all-in-one is totally right for us. Cut to 2 years later, using the all-in-one, we have our house entirely paid off.
We did not think that we could own a house at the stage that we were at 15, 17 years ago. Thank you, Linda, we discovered that we can. Then, halfway through paying for that house, she introduced us to another method that we could get to paying off the house. Something, again, we never imagined we would see that day. And thank you, Linda, we are now at that point.
I would love the opportunity to tell you more about this loan and to see how it can work for you.